Ever wondered how the rich manage to pay so little tax? The intrigue is real, and it's a puzzle that many of us often ponder. It's like a complex game of chess where every move is calculated and strategic. The wealthy, it seems, have mastered this game, navigating their way through the labyrinth of tax laws with finesse. The surprising truth is most of these strategies are completely legal. They're not secret tricks, but rather cleverly designed tax planning strategies that take advantage of loopholes and gaps in the tax code. The rich are able to keep more of their money, not because they're breaking the law, but because they're using it to their advantage. So what are these strategies? How do they work, and why are they so effective? These are the questions we'll be exploring today. Ready to unravel the mystery? Let's dive into these 8 strategies. First up, offshore accounts. Now, what's the first thing that comes to mind when you hear about offshore accounts? Swanky yachts, tropical islands, and a whole load of money, right? Well, you're not too far off. Offshore accounts are a favorite among the wealthy, but why? It's because they serve as a clever way to minimize tax burdens. Imagine you're a high-profile billionaire like Bill Gates or Warren Buffett. Your earnings are astronomical, and so are your taxes. So you open an account in a foreign country, move a portion of your wealth there, and voila, you're now subjected to the tax laws of that country, which are often more lenient. Remember the Panama Papers scandal? That's a prime example of how some famous personalities have used offshore accounts. But it's not always shady business. Many use these accounts for legitimate purposes, like international business transactions and investments. Offshore accounts, a popular method indeed. Next on our list, trust funds. Now, you might be thinking that trust funds are just for the silver spoon set, but they're much more than that. They're a tool, a clever way the wealthy use to legally sidestep paying hefty taxes. Let's take a look at how this works. A trust fund is a legal entity where assets are placed, managed by a trustee for the benefit of someone else, known as the beneficiary. The beauty of this arrangement is that while the assets are in the trust, they are often not subject to estate or inheritance tax. Let's consider a real-life example. Tech tycoon or media mogul, these high-net-worth individuals often transfer their wealth into trust funds. Their wealth is protected, and the tax man gets less. So what's the takeaway here? Trust funds aren't just about leaving money for the next generation. They're about smart wealth management, allowing the rich to stay rich. Trust funds, not just for the heirs. Ever heard of tax havens? Let's dive into it. Tax havens are countries or jurisdictions with extremely low or non-existent tax rates. These places attract the rich like magnets, offering them a safe haven to park their wealth and drastically reduce their tax bills. Imagine a complex global web where money flows from high-tax jurisdictions to these low-tax havens. That's exactly what's happening. The wealthy, with their army of financial advisors, are experts at exploiting these loopholes. Now, you might be thinking, is this legal? Surprisingly, yes. While frowned upon, the use of tax havens isn't illegal. However, it raises serious ethical questions about tax fairness and economic inequality. So, what are some popular tax havens? The British Virgin Islands, Panama, and Bermuda are a few that often make headlines. These places, with their sandy beaches and palm trees, aren't just vacation spots. They're tax havens, a paradise for the wealthy. Real estate isn't just about beautiful homes. It's a game of chess with the taxman, a strategic move often employed by the wealthy to minimize their tax bills. You see, when it comes to real estate investments, Uncle Sam offers a variety of tax breaks and deductions that can significantly reduce the amount of tax owed. For instance, mortgage interest and property tax payments can be written off on your tax returns. If you're investing in rental properties, expenses like repairs, maintenance, and even travel costs related to property management can be deducted. Then there's depreciation. With time, properties wear out. The IRS recognizes this and allows property owners to deduct a portion of their property's cost each year as a depreciation expense. And let's not forget about 1031 exchanges. Named after Section 1031 of the Internal Revenue Code, it allows investors to defer paying capital gains tax when they sell a property and reinvest the proceeds in a new one. Real estate more than just bricks and mortar. Next, we have shell companies. Imagine a company that exists only on paper with no employees, no office, and no real business operations. That's a shell company. It's like a hollow egg, looks intact on the outside, but there's nothing inside. Now you might be wondering, what good is an empty company? Here's where it gets interesting. Shell companies can be used to hide assets and income. Suppose you're a wealthy individual with a lot of money. You don't want to pay taxes on all of it, right? So you create a shell company and transfer your assets into it. Voila, your money is now owned by this company, not you, reducing your taxable income. But that's not all. Shell companies can also be used to mask the true owners of assets, making it difficult for authorities to trace the money back to you. It's a clever, albeit controversial way to keep your wealth out of the taxman's reach. Shell companies, a veil of secrecy. Charity isn't always just about goodwill. Now don't get me wrong, many wealthy individuals genuinely wish to give back to society. However, there's another side to the story that's worth discussing. You see, charitable donations can be strategically used to significantly lower taxable income. When large amounts are donated to charities, these amounts can be written off as tax deductions, effectively reducing the giver's taxable income. It's like killing two birds with one stone. You're doing good while also saving on your taxes. In the United States, for instance, the Internal Revenue Service allows individuals to deduct donations up to 60% of their adjusted gross income. It's a clever method used by the affluent to keep their money while also contributing to a cause they care about. Let's not forget, this method is legal and helps fund many important charitable organizations. So, in essence, it's a win-win situation. Charitable donations, a win-win situation. Last but not least, capital gains tax. It's the secret sauce in the recipe of wealth accumulation. You see, when the wealthy make money from their investments, it's often taxed differently than regular income. Here's how it works. When you or I earn a paycheck, we pay income tax, but when someone sells an investment for more than they bought it for, they pay what's known as capital gains tax. The twist is, the rate for capital gains tax is typically lower than income tax, so if you're a high roller, you might find it more beneficial to make money through investments rather than a traditional salary. This tactic is especially popular among the ultra-rich, who often have vast investment portfolios. In this world, it's not just about making money, but also about knowing how to keep it. And understanding the ins and outs of capital gains tax is a big part of that equation. Capital gains tax, a game of numbers. So, what does this all mean for our economy? You might be asking yourself. Well, the strategies we've just explored, from offshore accounts to charitable donations, they all have a significant impact on our economic landscape. These methods allow the wealthy to stash away vast sums, creating a financial divide that only continues to widen. When the rich, who have the most financial resources, pay little to no taxes, the burden inevitably falls on the middle and lower classes. This imbalance could potentially destabilize our economy and stifle growth. On an ethical level, it sparks a heated debate about tax fairness. Is it right for those with deep pockets to exploit loopholes while others bear the brunt? Or should we view these strategies as savvy financial planning? The answers may vary depending on who you ask. However, one thing is clear. It's a complex system, but understanding it is the first step towards change.